Okay, hello everybody. My name's Justin, Business Development Manager here at Fullerton Markets, bringing to you a class on fundamentals made simple and how we can understand the economic calendar. All right, so before we actually delve into the economic calendar, let's first discuss something that is very, very important. All right, and that is fundamental analysis. Now, I'm sure some of you who are joining us have been told that some people prefer to trade using technical analysis versus fundamental analysis. Some of you have been told that you may just need technical analysis alone when it comes to forex trading. Well, my take on this is simply that we need to use both. All right, imagine two of your hands, the left and the right, or if you're watching from the other end, it might have been inversed. So your left hand and your right hand. What if, let's say, you are dominantly right-handed? Would you stop using your left hand simply because you found it a bit troublesome or a bit cumbersome to use? The same thing with forex trading, right? You may be you might lean more towards technical analysis versus fundamental analysis, but you can use both of them, right? You can use fundamental analysis to supplement your trading and so that you can come up with an even better trading plan. Simply because fundamental analysis is equally as important as technical analysis. All right, but what is this exactly? Basically, fundamental analysis is analyzing the market through the economic events, the central banks, and the geopolitical events that may affect the supply and demand of a currency pair. All right, economic events, these talk about some data that comes out of the country every few days or every month or every few months. All right. The central banks refer to policies made by the central banks of a country. All right. You have one in the you have one in nearly every country, right? Followed by geopolitical events or events that happen within a country that can affect the supply and demand for that currency pair itself. All right, so let's dig a little deeper into fundamental analysis and some of these economic events and whatnot. All right, we talked about economic events earlier. There are quite a lot of economic events that you guys can read, can study. However, how do we know if economic events are actually important? All right. First of all, we have to go to a calendar such as forexfactory.com. Now, there are quite a lot of economic calendars out there, but Forex Factory is one of the best and most well used. All right. So since there are quite a lot of data that come out every day, we have to differentiate between which of these are important to you and me. Okay, so Forex Factory made that really easy by having this column here set up that says impact. And you can see there are quite a few colored boxes, right? So if the box is grayed out or it's the color gray, it's non-economic news, all right? It's nice to know, but may not necessarily move markets, all right? Followed by the medium impact news, which are colored orange. Now, these will move the currency, but to what extent? Well, medium, of course, followed by the red boxes, which are high impact news. Now take note of these as these will really move the markets and people really pay attention to these, right? And lastly, we have the low impact news or the yellows, which may or may not have an effect on the currency pair. All right, remember, gray, orange, red, and yellow. Red being the most important and gray being the least important. So what you can do is when you're actually looking at Forex Factory, take note of what are some of the red high impact news that are coming out for today and the orange ones so that you are prepared. All right. So how do we actually read an economic calendar, or rather, how do we use it? All right. Because I'm sure if you guys are using economic calendars for the first time, it is a bit intimidating. All right. Well, the first step that you guys have to do is prepare the news time. If you see here on the far left, there is a column that says the time and the time of the day and what time the news will be released. Now, you have to set this to match your area. Okay? Imagine if you're waiting for the FOMC statement at 2 a.m., 2 in the morning. What if you're in a part of the world where 2 a.m. in the US is, let's say, 10 p.m., or perhaps it's 2 p.m.? So this is a problem, right? You could be staying up all night waiting for news only to find out that you have actually missed it simply because the time zones do not match up. So the first step you do once you open an economic calendar is to change the time. So whatever part of the country you are from, let's say you are from the Philippines, GMT plus 8, all right? GMT plus 8. That way, once you look at the time, everything will be reflected in the time of your time zone. So instead of 2 a.m., this might say, let's say, 10 o'clock p.m., 9 o'clock p.m., and you can better prepare yourself for the news, all right? After preparing the time, adjusting it to whatever country you're in, whatever time zone you're in, you have to take a look at the news itself and then have a look at the previous versus the forecast. Now, why is this important? All right, the previous will tell you how this certain economic event performed the last time it was shared, versus what the experts are forecasting for this sharing of economic events. Now, how can this help you as a trader? Simple. If for example, the previous was, let's say, 100, and they are forecasting 200. Just based on this alone, you know where the experts are leaning towards, all right? You know what they are expecting. And if you know what they are expecting, you can come up with a sort of bias to prepare your trade, okay? For example, let's go back to the earlier example. The previous was 100, the forecast was 200, and if it does hit 200, it's good for the currency, all right? The currency should appreciate. Just based on the forecast alone, you can then more or less prepare yourself, all right, if let's say it's gonna be good for the US dollar, you might want to wait for a long or buy position on USD-based currencies, all right? This is one way that you can use the previous versus the forecast. But of course, this is not enough. After knowing the previous and the forecast and preparing yourself, we then have to wait for the actual to come out to compare with the forecast, all right? If the actual exceeds the forecast, it meets the forecast and actually goes further, that is great, all right? Depends on the news, but generally that is good. However, if it falls way below the forecast, that might indicate a bad thing for the currency, all right? Just because something was forecasted does not mean that is what the actual will be. However, it is an educated guess, and people, or rather the experts who come up with these forecasts, more or less have a basis to come from, and you can then, more or less see where things will go, all right? It's also very important for you guys to learn about each data in the detail area, all right? Just before the actual forecast and previous tabs, you can see a detail box. Now this folder, once you click the folder, it will open the news. It will go a bit more in depth and will show you some articles related to for example, the FOMC statement, okay? So 3 steps: prepare the news time, see the previous versus the forecast, and then actually compare the actual to the forecast. This is how you use the economic calendar. Clear so far? Great. Now, I'm sure the next question on your minds would be all about the actual economic data. Which economic data should we look out for? What do they mean? Because I understand that these terms may be new to you, right? These terms may not be used on a day-to-day basis if you are not coming from the field of finance, all right? But don't worry, we'll be tackling these topics very shortly, all right? Let's move on. What are some of the most watched news or some of the most significant economic data or reports out there? Right, guys? If you have a pen and paper or if you're on your cell phone, do take note, because some of the most significant data and or reports out there include the first being the central bank policies, which will more or less talk about how a central bank of a country plans to handle its fiscal obligations within the immediate, oh, well, quite soon, or for its long-term plans. All right. So these policies are important because you know what the central bank is planning to do, and you can then prepare yourself when it comes to your trading, right? There's also the interest rates, the retail sales that tell you about the spending within a country, as well as the consumer price index, changes of prices. There's also manufacturing data. There's also employment data. There is also the gross domestic product of a country. All right. Now, these are all important as they are indicators of how well an economy is doing. And if you have the indicators telling you how well an economy is doing, you can then plan your trades better. All right. You now have a sort of bias when you get to trading. Now let's go a bit deeper into central bank policies and interest rates. All right. If an interest rate hike happens, the central bank tells you we are hiking interest rates. All right. This will lead to lower economic growth, which would then lead to slower inflation, and ultimately this leads to a currency falling. Now, when the central bank says we will be cutting interest rates, meaning interest rate cuts, this will lead to higher economic growth, faster inflation, and will lead your currency to rise. Now, it's very important for you guys to know how these will affect a certain currency, because you might be reading and you see interest rate hike, interest rate cut. What do these mean? So now I have just shared with you guys how you can interpret these terms. All right. After central bank policies and interest rates, we have the retail sales or the consumer price index. All right. Generally, an increase in retail sales or the consumer price index would lead to an appreciation in the currency. So let's say you're looking at Forex Factory, you see the US CPI coming out right now, and the actual beats the forecast and it is positive. Then you might expect the US to strengthen, and you can then trade accordingly. Inversely, right, if retail sales or the CPI were to be negative, this would also lead to a dropping in the currency. All right, guys, I'm going to give you a few seconds to quickly write this down. All right. Positive retail sales and consumer price index leads to the strengthening of a currency. Negative retail sales will lead to a lowering of the currency. All right, clear so far? Let's move on. Next would be manufacturing. An increase in manufacturing data would then lead to an increase in the currency. And of course, a decrease in manufacturing will lead to a decrease in the currency itself. All right, meaning not a lot is being manufactured in the country, which could be due to less people buying things. All right, money is not circulating. This might be a bad thing for the country, hence the lowering of the currency itself. All right, after that, we have employment. When more people are employed, this is generally good and will lead to the appreciation of a currency. Now, if there are less people being employed, not good for the currency and will lead to a drop in the currency. All right, clear so far? Let's move on. The GDP, right? The gross domestic product. Now, each country has a different calculation for GDP. It depends on some of their exports and whatnot. But generally, if GDP were to increase, this would also lead to an increase in the currency, where a decrease in GDP would lead to a decrease in the currency. Clear so far? This is all very easy to understand stuff. And I'm sure now that we have shared some of this information, you guys can go out and actually supplement your trading. But I understand that you guys may not necessarily be ready to interpret data. Well, luckily for you guys, we at Fullerton Markets have prepared something to help you with that. All right, so before we dig into what Fullerton Markets has in store for you, let's first talk about what we have tackled so far. So first we had the central bank policies and interest rates, followed by the retail sales, followed by the employment, followed by manufacturing, and lastly, which we just talked about, is the GDP of a country. All right, so these are the 5 things that affect economies. These are the things we have to look out for when we engage in fundamental analysis. And thankfully, we just did a very basic tutorial on how we can interpret data such as these. All right, but just in case you guys want to make it easier for yourself to help you with your learning curve, we at Fullerton Markets have prepared something to help you. This is known as the weekly market report. So as a client of Fullerton Markets, we care about your education when it comes to Forex trading. We want you guys to be great traders, all right? Great traders. So we actually do a lot of the work for you. If you go on our website, we have a blog where we actually dissect some key economic data so that you guys only have to read, all right? For example, if we were to look here at the one presented in front of us, it says, for the first time in decades, the Fed's QE jitters investors, all right? What does this mean? You might not necessarily understand, but by reading the write-up, you would then have a clear picture, right? We also give out some recommendations. For example, market sees no short-term solution to combat the virus. You could short the dollar yen at its peak. This is an example of some trading ideas that we share in the weekly market report. Now, this is very beneficial for you guys, all right? Simply because now you understand, now you have a bias. If you were looking at the dollar yen and your indicators, your technical analysis say, hey, it's a good time to short, but you're not entirely sure if you should be shorting the dollar yen, all you have to do is read some of our write-up reports and see some of our recommendations. You could do it this way, all right? First of all, my technicals say short on the dollar yen, and the report from Fullerton Markets also says I should short the US dollar versus the Japanese yen. I will do this trade, all right? That's how you can put technical and fundamental analysis together. Clear so far? Great. So to summarize, all right, when an economy is doing good, when an economy is performing well, this will increase the value of the currency. However, if an economy is doing bad, this will lower the currency value overall. All right? So, ladies and gentlemen, we have tackled all there is about fundamentals and how we can make it easier for you all. Once again, my name's Justin Bernabe, Business Development Manager here at Fullerton Markets. Thank you all for joining me, and I hope to see you all at our next class.